India Equity Research and Managing Director at Morgan Stanley is with us now. Ridham, good morning.
Hi.
You're smiling because, last time you were here, you told me that, you'll have a big rally, a big top-down rally. And, of course, we've seen part of that play out. But for those who have missed the bus, is it too late or you can still, catch this bus?
Yeah, so far as global factors remain supportive, I think we're okay. This is 80% of this move which we have had since December is global. And it continues to be global. Actually, India is underperforming. The underperformance has shrunk a bit, but it's still underperforming. So imagine what other emerging markets are doing.
Yes.
We don't keep paying attention to that, but you should put up a chart.
That's commodity-heavy emerging markets like Brazil and Russia.
Commodity prices are not rising at the same pace anymore. There is a spillover of improved growth environment globally.
Okay.
The global growth is inching. I mean, it was at 4%. It ended 2016 at 4%. All forecasts for this year are around 3.3, 3.4. There's upside risk. We wrote about it last week. There's upside risk to global growth. So this is not an environment we've enjoyed since the crisis. Or maybe, briefly in 2010, we had a little bit of a spark in global growth. So that's going to spill over into emerging markets. And in fact, if you see since the middle of November, EM has outperformed DM,
yes,
which wasn't people's base case scenario because they thought EM was challenged by a rising dollar, by the new policies that were going to come because of President Trump. All that has not played out in that fashion because growth is strong. So yeah, if global markets remain supportive, I think this market still has room to go. Just on India per se, valuations relative to EM are quite attractive. We are at November 13 levels, which is the post Fed taper scare. Relative to bonds, we are at August 13 levels. So if you are a local investor comparing equities to bonds, equity is clearly preferred. If you're a global investor comparing India versus emerging markets, India clearly preferred. So it sits at the top of our pecking list on the EM asset class. And I would certainly think that the markets have relative upside from here.
This growth, global growth, that certainly came about in the last few months of 2016 that you speak about. Can the picture blur because of Trump's policies?
Oh yeah, those are the risks. Lata, I think this is a very typical global market that's climbing a wall of worries. And the wall of worries are a lot. I mean, there's.
But the action seems to be not cutting taxes in the US. It's not about spending on infrastructure. It is all about trade wars and protectionism.
No.
So it looks like a zero-sum game which is being snatched from somewhere else.
I think it's too early to comment on that. We've not seen any action.
No, it's certainly early. It's what, 15 days since the president took over, so or even less. So I'm not denying that it is early days, but I'm just worrying if we're also celebrating too early.
Yeah, so I would say that until those worries are there, the markets are okay. When those worries dissipate, then I'd get worried about the markets. So right now, I think there are enough people worrying about what's going to happen. It's very hard to tell what will be the sequencing of President Trump's actions. Will he focus on local economics first, or will he focus on global trade first? I think we will see that sequencing, and that sequencing will be very important for US stock markets and then global markets. We don't know that as yet.
Okay.
So that's, I think, the global picture.
Ridham,
go ahead.
Sorry, the key point which has distinguished this market from, say, previous markets been the kind of domestic buying that we have seen. 13,000 crores, matching dollar for dollar the FI is selling. Do you think that trend could continue, or could we have a Goldilocks scenario where both domestic liquidity is there and the foreign liquidity comes back?
Yeah, I think I've said it many times in the last 2 years. It will continue for the next 10 years, and it will accelerate. I think equities have become a more reliable asset class for domestic balance sheets. Domestic households, just to recap the numbers, we've said it on this channel many times before, but I'll recap the numbers because people keep getting these doubts about domestic flows. Saving by households on an annual basis is about $400 billion. If they put 5% of that into equities, that's $20 billion. So that's, I think, a very reasonable run rate to assume for domestic flows. Therefore, the consequences of that are that mid-caps get bid. And however much I worry about mid-cap valuations, and they're trading at a fairly rich premium to large caps, a little off the highs in October, but still at a rich premium. You know, that may sustain for a while until it blows up. And the other thing it means is that you know, these corrections are proving to be shallow and swift, because the nature of money that's coming in is systematic. It's monthly commitments that people are making. 3/4 of the money flows are in SIPs. So it kind of insulates the market in that sense. Now, this will not continue forever. I mean, at some point in time, this story will break. But the flow into equities, and given households' exposure to equities, which is quite low in their balance sheet, we estimate that it's about 5% of household balance sheets versus gold, which is close to 20. I think that asset allocation shift is happening on a more structural basis. The opposite of what happened 25 years ago, when households used to invest 25% of their incremental saving into equities and not that much into gold. And we saw a flip through the 90s because of low returns and because of successive scandals in the market. Households preferred gold. Now I think we're seeing a reversal of that. So there is a structural undertone to this.
But would you worry about the domestic growth story? Certainly it was a workman-like budget, as some people have described it. It had no bad news. But is there a growth bullet? You know, or are we going to be mired in modest growth even in FY18?
So, Lata, I think credit to the finance minister that he resisted the temptation that his previous predecessors have succumbed to, which is, you know, put bombs into the fine print. So I think that's one big takeaway. Obviously, I think the market is looking joyous because there was wide-scale wide-scale expectations about capital gains tax, which is a minor item from a budget perspective. The market had made a big deal out of it. So that's not there. There is a clarification on indirect transfers, which is another positive for the market. So the market has hung on to these few things because the market wants to go up. Okay. In another situation, in another circumstance, if the market wanted to go down, then if they're focused on the things that went wrong, I looked for them, by the way, and I found 4 things. Okay. And it's a struggle. This is the shortest list.
Of bad news.
Of bad news in probably 2 decades. Okay, so what did I find? I found that there's a lack of corporate rate cut. But you know, that is what that was in versus expectations. It's not about the fact that it should have happened. It was that we were expecting it to happen and it didn't happen. We found that there's not enough set aside for public bank recap. I think that's a positive. But there will be other people in the market who may think that's not such a positive. I think the real only thing which I am a little bit, I would say, wary of is the divestment target. In the sense that if it is achieved, it portends a $11 billion issuance pipeline. And if it is not achieved, then it puts the budget numbers at risk. So it's kind of, you are stuck between a rock and a hard place as far as that number is concerned.
But you know, the tax revenue assumption is only 12.7% higher, which is also modest. So what he loses in divestment, he may make up.
No, but Lata, that's got 2 parts to it. There's a 25% increase in personal taxes. And there's a subdued number for indirect taxes because there is GST implementation baked into the numbers. So that's the other thing that you take away, which is that the finance ministry is assuming that there's a GST coming, and there's a loss of revenue on account of that. Because
which is a careful thing to do. The personal income tax is probably premised on the fact that there may be a larger tax base because of demonetization.
So that's an assumption, and that could get challenged. We don't know. And it will be a good result if we get 25% growth. We are finishing this year with a very strong number, but there were some one-offs this time. There is a greater emphasis on compliance. Clearly, the budget is all about transparency. It's about reducing cash transactions. I think we are making headway in that direction, and hopefully that translates into higher personal tax collections. So, per se, on the numbers, I don't think we want to debate. Now, going back to your point on growth, I think there are 3 pillars on which India's growth story is standing. One is government, or I should say public sector spending. That remains quite rich relative to GDP. We are probably going to cross all-time highs this year. And nothing in the budget actually prevents that from happening. So the budget continues to support that. The second is global growth, which is a new thing that has come into the game. It wasn't there for the last 2 years. So that's supportive. So you'll see exports will do better. Exporting companies will do better. They've been struggling for the past 3 years. The third is, as a consequence, consumption is actually looking quite okay. So there is, and you could see that in December, the worst that was expected on the demonetization did not happen because the underlying consumption demand is strong. I also think that demonetization leaves a little bit of a upside risk in the system because of the liquidity that banks have. And this is very basic economics. If you have that supply of liquidity, what are you going to do with it? The banks will lend it. So lending standards may drop and it may end up in a bad situation 3-4 years later. But today, I think you get loan growth. So I'm actually bullish on loan growth, both corporate and retail for this year. Okay. And that essentially means more consumption. And as all these things happen, utilization rates go up and eventually translate into private capex, which may not be the story for this year, but it may be next year's story. All 4 cylinders are firing. Yep. So this automobile is moving forward.
Yeah, but Ridham, a lot of this could be in the price. I mean, Maruti yesterday made a lifetime high, 6,200. Eicher is almost there. Yeah. We have seen IndusInd Bank, Yes Bank, HDFC Bank, Kotak of the world nearly there. You think these engines could still fire from here?
Yeah, no, that's a very good point. I don't think they are in the price right now. I mean, I made that point that valuations are actually quite okay relative to bonds and emerging markets. And the growth that's being priced into the market today is a lot less than what it was pricing in 2.5 years ago. In the middle of 2014, the market was pricing at a 20% CAGR in earnings growth. We didn't get that. Yes. And subsequently, we've had time loss of money, right? And that has basically mean that there's been a reset in market expectations for growth, which is why this surprise that has come in certain sectors and certain companies is producing such a big reaction on share prices. So I think that's because there's not that much growth pricing. Of course, down the line, the markets will get excited and a lot of that growth will get pricing, but we're not there right now.
So what are the market's leaders now?
So I think in terms of consumers, you want to back the discretionary guys. I think they'll do well. In financials, I think NBFCs, I would prefer them over retail banks because in the retail banks, there will be some NIM compression as a consequence of the lagged effect of the rate cuts. The NBFCs' liabilities reprice a lot faster. So I think they'll face lesser pressure. And loan growth will come, I think, almost everywhere. So the ones without the NIM pressure will probably deliver better earnings. So we are more skewed towards NBFCs over retail banks. We still like select private sector retail banks from medium-term growth story. I think technology, because stocks are really battered. And I think you want to step in and buy these stocks. I said that a month ago and they are actually lower. I don't see any reason to change my view as yet. I think people have become a little all too bearish about US policies. I think that's really the 3 big sectors you want to bet on. I'm still not so enthused about industrials. I think it'll take a little while.
What about telecom? Because that's made a huge comeback. And I was just looking at shareholding pattern, for example, of Bharti. Not too many Indian retail shareholders have any kind of exposure to telecom stocks. Yeah. If 4 large players becomes 3, which is now almost a reality, do you think there could be more re-rating?
Consolidation is positive. So I think the worst may be behind us for these companies, but there may still be a little bit of pain left to be absorbed. So I don't have a strong view actually, not as strong as a view I have on the other 3 sectors I mentioned.
Because they've had multi-year bear market. You think maybe bottom is in place, but they will still not give you big returns?
Probably, I don't know actually. There are some things that I cannot see very clearly. Okay. Not that the things I see clearly I go right on. That's a different debate, but I'm not able to see it clearly. So
you're confident on IT?
You don't have to be so modest.
I'm not being modest is a fact. I keep measuring, I do slightly worse than the toss of a coin.
But nevertheless, I'm going to ask you to measure something. How much more gains are left this year?
For the market?
For the market, for the index.
So when we met in December, I argued that we are heading for double-digit returns in 2017. So I think we are on course for a 15% upside from where we were, and that has not changed really because I think the growth environment is getting better. The budget doesn't contain anything to upset that. People ask me about state election results. I don't think the state election results either are going to upset that. Equities want to buy growth, and if growth is coming in, all these things will be overlooked. They'll find positives even in a bad state election result. So there is a bid. I think that's okay, and it will so happen, as you rightly point out, which is that at some stage we may go ahead of the fundamentals, and then we'll come back and check.
9% of that 15% has already happened actually, with only 1 month gone for the year.
So no, and very good
always
point,
comes
Anuj,
that.
which is that, see, all absolute returns have to have a context, okay? And the context is where India stands in a relative situation, and the world returns are also running ahead of expectations. So as I said at the start of this conversation, if that framework remains, then this 15% may prove to be conservative. Because 15% is not in isolation, it's not in vacuum, it's in the context of a global picture.
Okay, just one final word. You're confident on IT, but not so much confident on pharma, or is that also a contra bet for you now?
I'm not confident on IT in that sense. I'm just saying that, when you don't feel so good about it, it's always a time to check. And I think IT stands in that situation. Pharma is more stock specific. It's not a sector call I want to make. In IT, you can make a sector call. All the businesses have similar models.
Yes.
They'll be driven by the similar factors. There are very few idiosyncrasies. Pharma is very idiosyncratic. The companies are quite distinct. So they're not going to be driven by the same thing.
Don't take a sector call. Thank you very much, Ridham Desai.
And we ended up discussing so little about the budget.
But
Yes, it's the day
was
after,
that kind
so
of
it's
budget,
over.
right?
Well, it was a no news is good news budget. Thank you very much.